Well, India Ratings and Research has maintained an overall stable rating outlook for large corporates for the second half of the year, and this is on the back of a broad-based recovery and improved balance sheets through this cycle. Of their rated portfolio, 82% has a stable outlook, unchanged year-on-year, and it also finds that barring export-oriented sectors, recovery in large corporates has been generally broad-based. While balance sheets of corporates have improved, household leverage in fact has crept up and government deficits also remain fairly elevated, and as a result, sectors like commodity, chemicals, construction, textiles and Tier 2 realty players could remain vulnerable to a slowdown in growth and elevated costs. This is the findings of the report, and joining me now to discuss it is Vivek Jain, the Director of Corporate Ratings at India Ratings and Research. Vivek, welcome to CNBC TV 18. Thank you very much for your time here. A stable outlook for the second half, your report says, but the theme of bipolar recovery, doesn't that continue to play out with some of the sectors recovering better than the others? And even within segments, isn't that playing out? So what are pockets of stress and which are the pockets that are now emerging out of the woods?
Thank you so much, Ritu. Our pleasure is completely ours. So I think from a directional perspective, if you were to look at either, as you rightly said, it's been a broad-based recovery. But from a sectoral mix, if you look at three sectors we have specifically pointed out, which we believe could be in the woods for some time, they are largely textiles, construction, and Tier 2 real estate. And within sectors also, we are seeing a K-shaped recovery, whether you look at autos, where cars are selling more, higher-end cars are selling more. Similarly is the case on the real estate side, where Tier 1 developers are doing far better than Tier 2 developers. So it's visible in sectors also, within the sectors and across the sectors.
Vivek, what about capex expenditure? That's kind of remained uneven. We've been seeing more brownfield expansion than greenfield from corporates in the last few years. What about government schemes like PLI, for instance? Are they moving the needle when it comes to manufacturing? And is it showing in the numbers yet?
Right. So capex, I would say, has been not very broad-based. It's occurring in select sectors. Like we typically say, three sectors account for bulk of the capex, which is your power, oil and gas, and the EPC segment, so to say. So these three segments, would account for the bulk of the capex, and that continues to happen. Right. So there is, I would say, limited pockets where we are seeing, and incrementally the capex is largely brownfield rather than being greenfield, which is the point when you really start seeing those, animal spirits back in people spending on new capex. So that seems to be missing. We are still on that brownfield mode, where incremental capacities are small percentages of existing capacity. You could say the capex mode would be full blown out when you see an announcement coming, which is, let's say, X percentage, which is above 20% of the existing capacity. So those seems to be, missing, and people are doing modular capex, so to say. It's still not, whole hog out and doing and setting up a project in bulk. It's still modular in nature. On the PLI bit, we are seeing select sectors where PLI has picked up, and people are putting up capex in order to take those benefits. But still, the underlying driver still has to be the demand. Ultimately, the product has to be off-taken. Only then the PLI can support. Right. So we have seen some sectors take those benefits, but otherwise it has been limited to a few sectors. And lastly, we have seen capex pick up in sectors where China plus one or Europe plus one in that sense has played out to their advantage. So those would be some places where capex is largely visible.
But Vivek, do you have a sense of what kind of capex is planned for the remaining half of the year? And, what are the specific industries that are benefiting from this China plus one strategy already?
Right. So I think the typical names that we, usually when we speak to the corporate clients, the people who seem to be doing a lot of capex on these sides are largely on the chemical side. You would have somebody doing, capex on specialty chemicals, and, some of these related. The chemical side is one place where we feel, it's largely taking place. But otherwise, exports seems to be picking up in a lot of other areas also, like capital, which is one example. But that might not be purely a China plus one phenomena. It could also be because of the investments, let's say, the US and Europe are doing in terms of greening their own grids. So, it's difficult to segregate, but wherever export facing, businesses are there, we are definitely seeing some momentum, barring the sectors that I initially spelled out, where, the likes of textile, where we are still seeing some kind of a pushback in terms of offtake. But otherwise, in some of these sectors, which are largely dominated by China, we are seeing people put up capacities in India, where exports could be done. Pharma is another example, where we have seen a lot of, and India happens to be the global pharma capital from that sense. So you've seen fair amount of capex happening from that perspective.
Okay, that is as far as capex is concerned, but what about financing for it? If you look at the bank numbers, we've been seeing solid advances growth in double digits, but a lot of it is focused on retail, not so much on corporate. And even in capital markets, as we've continued to see, the better rated, larger corporates are able to get financing at better rates than some of the others. Is the condition improving much, or, how's the market looking at the moment?
Right. So it's a great question. So I think if you look at our portfolio also, right, bulk of the action. So if you look at 82% of the portfolio is rated as stable, remaining 10% is positive, and 8% we are saying is currently with a negative outlook or a negative directional indicator. Now, large part of the negative actions that we see are restricted to the bottom end of the rating curve. You could have from an A- to a triple B, but largely restricted to the triple B category and below. Now, what that seems to suggest is two things. One is credit availability at the bottom of the cycle, bottom of the curve still remains limited. So there also you have that K-shape which we just talked about. It's not just on the corporate side, but also from a lending perspective. Banks are wary of lending to corporates at the lower end and very happy to lend at the corporates, who are rated highly. And similarly, the liquidity also plays out in the same fashion. So corporates who are rated better, who enjoy a better rating, have been able to access markets, are not facing that heat of rise in interest rates or availability of liquidity. But somebody who is lower down the pecking order is definitely feeling those heats, and hence those ratings which we have on a negative outlook also reflect those liquidity pressures which we believe would have played out.
Vivek, a quick clarification. The distribution of your rating outlook, that has a marginal negative skew when you compare it to the distribution of sectoral outlook. What explains that?
Sorry, Ritu, you'll have to come again. I couldn't catch that.
Well, the distribution of your rating outlook, that has a bit of a marginal negative skew when you compare it to the distribution of your sectoral outlooks that you've given. What explains that difference? Because overall, the outlook is stable for 82% of your rated portfolio.
Right. So there are two different, two ways we assign these outlooks. One is what we call as the sector outlook, and other is what we call as the rating outlook. So rating outlook is for companies that we rate, the portfolio that we have, while sector outlook is at a broader level. So, we could be observing stress in something that we don't rate, or it's a general comment about the sector per se. So the sector bias could be negative because we are seeing, as I said, if you look at the distribution of corporates also, so beyond 500, there's a long tail, right? So a number of corporates which are seeing those stress, as I said, in the lower rated portfolio could outweigh the portfolio that we have, right? Our portfolio can be, let's say, it's largely, a good portfolio which is visible. 82% is, rated strongly. So those differences can arise when you are taking a call on the sector versus rating your own companies in that sector.
Vivek, we have 10 seconds to go, so just a one-line answer. The top 2 to 3 risks for the corporate sector in the coming months?
So I think it's the K-shaped recovery, availability of credit and the cost of credit. And third, if capex picks up meaningfully, then are the balance sheets deleveraged enough, or would they re-leverage pretty fast? So these would be the top 3 risks that I would think.
Okay, Vivek, thank you so much for taking us through that. Thank you very much. It was a pleasure speaking with you. But on that note, we're going to wrap up this edition of Business 360. Thank you very much for watching. But stay with CNBC TV 18. News and updates will continue.